The lease events analysis is important to the property industry because income is everything. 75% of the total return from IPD year on year comes from income on average. So therefore income is everything. Understanding what happens with income is essential. So therefore the lease events provides a benchmark for the industry to start looking at income, particularly as leases have got shorter. So DCF analysis is important. You've got to understand what the propensity to break, what the likelihood of lease renewals, what the propensity for delinquency in income streams is. And that, to my mind, is something that we have provided to the industry. I've always thought it was essential. We've encouraged IPD to produce it, and I think that we've done this for well over 10 years now. I think it's essential.
Well, the main differences between the 2011 results compared back to the 2010 results is really a continuation of the trends. That we're seeing a lot of vacant space on the market, and asset managers are really trying to think about what kind of probabilities they're going to have to incur. Are they going to be able to keep their tenant, or are they going to be left with vacant space? Is that break option actually going to be used or not? So what kind of risks are they leaving themselves open to? So really it's a data set that really helps them kind of think about those risks and think about current trends as well as future trends for their cash flows.
The increase in shorter leases, in more volatility and uncertainty in many leases, creates much more of a polarisation between long-let, annuity-style income and short-let, sort of standard real estate, which means that we'll see a greater price differential going forward and a much wider split of demand between the two.
You know, we're living in very uncertain times, and this reflects all the way through the business community, and indeed it reflects in this report on lease events. Leases are getting shorter, break clauses are getting more common, and the risks are increasing in the market. The question then is, are those risks being reflected in prices? And it appears they're not, that the survey seems to suggest that it's not being reflected. That has to happen before we see liquidity coming back.
We ran an audience survey prior to the event, and we got a great response from people, and there were three key themes that came out of that survey. One being around demand, and occupational demand being a great, the biggest barrier to risk in the medium term. Another around risk more broadly, and looking at property in terms of the wider asset availability to investors. And thirdly, interestingly, around supply and stock. And the audience almost unanimously looked at stock as being reduced in our core market. So 70% thought that there was less stock available permanently than there had been previously.